Okay, this is lesson 85, and this is on the functions and the characteristics of money. So money has certain functions like the medium of exchange. People must be confident that when they're given money that you can use it to buy goods, otherwise it ceases to be money. It must also be useful as a unit of account. So for instance, if you take this jacket here is worth say 20 quid, and we must be confident that you can divide that money up into 20 pounds, it's worth 20 quid. This t-shirt is worth a fiver. So you must be able to use money to value products. It must be also a standard for deferred payment. So for instance, if I lend someone £1,000, then I must know when I eventually get that money back that money is still worth a thousand quids. And it must also be a store of value. What this means is that when you get paid, if you happen to keep that money, you must also know, of course, that in the future you can also use that money to go out and buy another product. So these are the functions of money. And money must also have certain characteristics. Pretty obvious, really. I mean, they always use the age-old example of if you've got a pig, if you're going to buy something, is a pig acceptable? Can you divide the pig up? Is it divisible? Is it possible to forge it? Can you carry it around with you? So these are all the characteristics of money. And we sort of know this already. If you give someone 100 quid, then we know roughly what we will be able to do with it. But this is quite a modern concept. If we go back 2,000 odd years, obviously there wasn't really money around. People had to use wives, they had to use gold. Okay, lesson 85, and here we're looking at narrow money and broad money. And narrow money is basically notes and coins, but money that's used as a medium of exchange, whereas technically broad money, or M4, is narrow money plus also money that firms and individuals place in the banks, and also much larger deposits also put in by firms or by financial institutions, and that makes up a broader definition of money, which is often called M4. However, I also think a lot of the money supply that suddenly massively increased just before 2007 was because our banks were getting a lot of oil money was coming in from other countries, and the classic case of that was Northern Rock, who borrowed short and lent long. And what does that mean? It means that when they borrowed the money from the Gulf states, they were paying maybe 2 or 3% back to those countries, but they were lending it out on a long-term mortgage, say over 25 years, and they were lending the money out at 5%. Now the difference between those two was the profit that Northern Rock was making. Obviously Northern Rock was also being paid by its customers, were putting money in the bank like any other building society. But as soon as the funds started to dry up and all the money suddenly came out of Northern Rock because they were suddenly scared that they may not be getting their money back again, they withdrew all their money, which they were allowed to do, and hence Northern Rock was short of money. And then all the people who found out about it, great big long queues outside Northern Rock, because they were desperate to get their money and life savings out. To that end, what the government has done, it's guaranteed any deposits in any bank up to £85,000. So if you've got £85,000, your money is guaranteed to be given to you by the government if the bank goes bust. And that will stop people from having a run on the banks. But basically that is the money supply. There's a narrow definition of money, which is basically notes and coins, which is used as a medium of exchange, and a broader definition of money, which is characteristically M4. Which is the capital market, the money market, and the foreign exchange market. And this particular session, I'm just going to keep it really brief. But the main purpose of why we have a financial sector is to raise money for firms, and then firms invest that money, and so that shifts out the long run aggregate supply curve. And any new business that starts up will always need loads and loads of money, so it needs to go somewhere to get hold of that money. And one of the ways in which you can get hold of money is either through shares, bonds, or a bank. Now, after this session, I'm going to talk about bonds. But what bonds do is you can raise money through bonds, and someone will come along, they'll say give you £1,000, and then every single year you must pay a rate of interest on that bond. So that rate of interest may be, say, 5%. So every year you pay them back 50 quid, and then in 10 years time they may get their £1,000 back again. So a bond is a sort of slightly safer form of investment for the individual. Whereas a different one to that is a share, which is much more high risk, which is whereby you invest money in the company. Hopefully the company will make loads and loads of money, and then as a shareholder you will then make a lot of money back. But that's a much more risky form of investment. Now what I'm doing today is I'm talking really about the financial sector and roughly how it should work. Later on I will talk about the role of financial markets, but also the risks that financial markets hold for the economy, and how that risk may go into the real economy and create real problems, which is what happened in the credit crunch in 2007-2008. Okay, so basically the money market is for short-term finance. So if your firm is having problems, if your firm needs if your firm needs some cash to pay the workers, or the government needs some cash to pay its bills, then they will go to the money market, and that will help with their liquidity. Also, other firms will put money into the money market if they've got any spare cash, so they will get a very low rate of return on that money when they give it in there. And then other firms who need money quickly will go into the money market, and they will borrow that money maybe for a week, 2 weeks, or a couple of months. So the money market is definitely short term. If you do want to invest in the money market, it's very low risk. Your returns will obviously be lower, but they're almost guaranteed. The capital market, which is really the stock exchange, is something entirely different. And here, if you want to invest in it, you probably want to invest in it for the long term, because the chances are it will go up and it will go down, but overall it's likely to go up. But over a period of 2 or 3 years, obviously you can lose a lot of money, and you can also make a lot of money. So this is where the risk tends to be very, very high. And that's where firms will come to borrow money. Obviously, if the company goes bust, then you will lose all of the money that you put into that firm. So it tends to be for long-term investments, and tends to have very, very high rewards. The foreign exchange market is absolutely huge. It's basically used to help in terms of international trade. But within that market, there's going to be a lot of speculation, because if you say buy up £10 billion worth of sterling, and then the sterling happens to go up by, say, 1%, then overnight you would make £100 million. So there's a lot of activity in the foreign exchange market, and particularly now we have floating exchange rates. If speculators feel that a currency is in a very poor way, then they will take money out of that country, and hence their exchange rate will fall. It's a huge market. It's something, the turnover per day is something like $4 trillion. And if you think that is probably about twice the size of the UK economy, you get to the whole size of the foreign exchange market. But I'm going to leave that until a later date. But that is, in broad terms, that is the financial markets. You've got the money market, you've got the capital market. Capital market is long term, money market is short term, and then we've got the huge foreign exchange market where we've got loads of speculators moving around, but you've also got a lot of international trade taking place, and it eases that process. Okay, lesson 85, and this is interest rates and bond prices. Now, I can get over this one quite quickly, because I can just say, well, as interest rates go up, bond prices fall, and as interest rates go down, bond prices rise. So there's an so therefore there's an inverse relationship between those two variables. All over, but I really want to explain why that process takes place. Okay, let's assume that we have a a government bond, and it's £1,000 bond, and it has a 5% rate of return per year. So you're buying for £1,000 and every single year you get back £50. We'll also pretend that this bond is in perpetuity, and what that means is it has no maturity date. Okay, so you're actually quite happy with that, but you're a bit short of cash, so you want to go and sell it. Now, if suddenly the rate of interest is no longer 5%, but the rate of interest is 10%, unless you're talking about a complete nut job, no one's going to buy that bond for £1,000, because they're going to buy that bond for £1,000 and they're going to get a 5% return, whereas they can go and buy another bond for £1,000 and they're going to get a 10% return. So therefore what's happened there is the rate of interest has gone up and you've got to sell that bond for less. Okay, you're not going to be very happy about it, but the only way you can get a 10% return on that bond now is to sell it for £500. So what's happened here is that the interest rate has gone up from 5% to 10%, and you would then have to sell your bond at £500 to bring in the cash. Okay, however, if the rate of interest goes down, let's say it goes down to 2% now, and your bond is giving a rate of return of 5%, so therefore you're going to be quids in and you'll be happy to sell your bond, because someone may then come along and say, well, we're going to get we only want a 2% return from that bond, so they would then be willing to pay £2,500 for it. So there, the rate of interest has gone down, right, to 2%. So therefore, the price of your bond has in fact gone up to £2,500. Okay, what I've done is I've just kept that very, very simple, but I just want to show you that the relationship between interest rates and bond prices is an inverse relationship. And I just want to bring them up to date with what the government's been doing both in America and in the UK. Is they've been through the process of quantitative easing, whereby they've been buying lots of bonds off the banks because the bank's been holding the bonds. So therefore the banks have more cash, therefore they have more money to lend out, therefore they lower the rate of interest, therefore it may well be the case that bond prices go up. Now at the same time, because they've lowered the rate of interest, is that we're going to get the transmission mechanism moving off consumption and investment, so then hopefully we're going to get more demand in the economy. Now if we get more demand in the economy, actually that might make the stock market go up, and with such low rates of interest, why do people want to buy bonds in the first place? It may force that money into the stock market. The problem then occurs, obviously, is then we may get a stock market boom, which is what we don't want. However, at this moment in time, the government just wants to stimulate the economy, and this is part of that process of using quantitative easing to buy up bonds from the bank, so therefore they've got more cash. Okay, bond prices and interest rates. And this is just looking here at the basics of bonds. I'm not quite sure what the examiners want here, because they put down the words coupon and they put down the words yield. Now what sort of yield does that mean? Does that mean a flat yield, or does that mean a yield to maturity? Because they're both slightly different things. But what I'm going to do is I'm just going to talk you through bonds and what a flat yield is and what a yield to maturity is. So we've done both anyway. Right. Well, why do we need bonds in the first place? Well, we need bonds in the first place because the government is often in debt. The government will often have a budget deficit, so therefore it needs to sell bonds to people to raise money. Now, but why on earth do people want to buy bonds? Why don't you want to buy shares, or why don't you want to put money in the bank? Well, recently people have been very, very keen on buying bonds, and the reason why is it's unlikely that the government is actually going to go bust. However, Greece did go bust and had a AAA rating, and I wouldn't be quite so sure about even the UK government not going bust, because in a way it's actually printed money and monetized some of that debt, which in a way is sort of saying, well, I'm not quite sure we can afford to pay it all back at some stage. Anyway, people buy bonds because they're a safe form of investment. All right. So most bonds, I'm going to call this bond a bond. It could be called a treasury, or it may well be called some other form of name. But most bonds are given a nominal value of £100, and then they're also given a fixed rate of interest. Now this one's got a fixed rate of interest of 5%, and that means 5% of £100, obviously £5. So this is the coupon. So we've now done the word coupon, and that's what that means. Now, if you look up the Financial Times, you'll also have a maturity date on there. This is the year 2014 as I'm talking, and the maturity date is 2018. And then over on this column down here, they'll have the current market price of that particular bond. Now, remember in the previous lesson, I was saying that there was an inverse relationship between the interest rate and the bond price. Well, in this case, the bond price is worth £112. So if I want to work out the flat yield, this is a relatively straightforward exercise, because what I do is I'm getting a £5 return. I bought this for £112. So therefore my flat yield is 5 divided by 112 times 100. And if my maths is roughly correct, that gives me a flat yield of 4.46%. Now, in a way, that sounds quite good. I'm quite pleased with that, because I wouldn't get that from a bank account at this moment in time, and in times of a recession, to even get a return is actually okay. Right, but I haven't taken one thing into account, and this is what the yield to maturity does. Now, in this case, in 4 years' time, I'm not going to get £112 back. I'm only going to get £100 back. So what I then do is I say, okay, I'm losing £12 over 4 years. So £12 divided by 4 is obviously £3. I'm actually only getting £5 back. So in reality, what's happening is I'm getting £5 back every year, but I'm actually losing £3 every year. And I divide that figure there by 112, because that's how much I'm actually paying for that particular bond. So what happens then is that's then £2 divided by 112 quid, 2 divided by 112 times 100, and if I work out all the figures, I think that comes to roughly 1.78%. Quite clearly, I worked that out earlier. I'm not that clever, I can assure you. So that is now my actual yield to maturity. That figure there does not look quite as good as 4.46%. However, 1.7%, is that actually that bad? Now, right now, people are still buying government bonds, even though they're getting a very low rate of return, roughly 2%, because that is still a safer form of investment than buying shares. But the problem with shares is right now, in a sort of after a recessionary period, they may also be going down in price. Now, just on the slightly bigger picture here, one of the things that the government has tried to do by using quantitative easing is they've gone out and they brought bonds, and the reason why they brought bonds is because they want to move people into other forms of investment. So by buying bonds, that will increase the price of the bond. That means the rate of interest people are getting on those bonds is actually going to go down, and that may force people into buying other forms of investment like shares. And shares, if you buy shares, then you're putting your money into the private sector. So that's it. The one thing we haven't taken into account, and it's not quite this simple, is we haven't taken into account the time value of money, which is a concept that you do a lot in business studies, but hasn't really appeared in economics before. But to say that £10 today is probably going to be worth more than £10 in a year's time. And the reason for that is because of inflation, so that £10 will not be worth in a year's time, will not be worth as much as it is today. Anyway, that is the basic of bonds. There's some words that you need to know: coupon, yield. I'm not sure on the syllabus whether they're talking about a flat yield or a yield to maturity. And of course, you should also know what a bond is. And you should also know the wider economic issues is every time the government sells more bonds, you're taking money away from the private sector.